One moment. Help yourself. Okay. All right. So let's start the class now. All right. For chapter 5 last part, I have already mentioned to everyone that because you will not cover disposal for BBFA2024, so that's why you can skip question number 1. But then we will still proceed with associate, okay, with associate. So that's why you have to complete question number 2. Okay, so today we will only focus on one question, which is question number 2. And if you feel that you need extra exercises, you can always go to Revision Hub. All right, I have already posted chapter 5 last part revision question, subjective questions and answers for all of you. And I have also posted these self-assessment quiz for the chapter 5 last part for all of you. All right, please do attempt the questions, okay, if you have a weak understanding about consolidation. All right, if you don't do more practices, you will not be able to understand. Okay, so for today, I will use another approach to teach all of you about consolidation, because I noticed that if I explain through double entries, a lot of students cannot understand and sometimes you might get confused. Of course, if you understand the origins of the double entries of these adjustments, it would be good. But then I noticed that at your level, if I force you all to understand through this manner, it might be a little bit difficult for all of the students. So I will just use back a normal approach to teach all of you. Okay, so let me just present my answers. Wait. Okay, not answers. Basically, it's just a skeleton. All right, so this is basically my answers that I usually generate, okay, how I usually generate for consolidation. So these are the skeletons. I think it's too big. Okay, so these are the consolidated statement of financial position and consolidated statement of profit or loss. So as you can see, regardless whether it's a subsidiary relationship or associate relationship, I will still be using the same format to produce my consolidated statement of financial position and consolidated statement of profit or loss. It is never different, okay? It is never different. It will still be the same. The only thing that is different is that if, let's say, in the event I have associate, okay, I will not amalgamate in the financial statements. All right, this is the first thing that I want to brief each and every one of you, because I noticed that throughout the weekend, I still have students asking me questions like, teacher, for your revision hub question, why this I don't have to calculate non-controlling interest? I thought we have to calculate non-controlling interest all the time. Now, answer is no. Okay, please remember that in the event that you have an associate, you don't calculate non-controlling interest for an associate, because you yourself is actually the non-controlling interest. Okay, so there is no non-controlling interest for an associate, and you will account for in accordance with equity method. It is not in accordance with full consolidation method. Okay, so as you can see here, I took out column D. I didn't amalgamate column D inside. It simply means that for this particular question, we have an associate. Okay, I have not read the question yet, but since I designed my answers in this manner, I know that Prada is an associate to Gucci. That's the main reason why I didn't add in to my calculation. Okay, so that is the only difference. If, let's say, it's a subsidiary, you just need to combine. It's a very simple a very simple sum formula that you are using only. But if it's an associate, you can still prepare using my format, all right? But you don't combine the financial statements, okay? That is very, very important. All right, now let's move on. Okay, so I need all of you to read your own questions, yeah, as I will also have to read my questions so that I don't have to present here and there. Okay, so Gucci Berhad acquired 10% of the equity capital of Prada, which is equivalent to 250,000 shares 2 years ago at a price of 800,000 when Prada's retained earnings were 6 million. Gucci gained significant influence over Prada. Okay, so for the first paragraph here, basically, we know that Prada is an associate to Gucci. Why? Because the question has already mentioned Gucci gained significant influence over Prada. So if there is a significant influence, that simply means that it is an associate relationship. Okay, on 1st November 2018, Gucci acquired an 80% equity interest in LV. The retained earnings of LV stood at 7.5 million at the date of acquisition. The agreed consideration was 10 million in cash. Okay, so again and again, you can see here for question 2, I did not test you on shares consideration yet. I have not tested you on contingent and deferred consideration yet. So wait, I will definitely test you on that, but not for your test 2, okay? Not for your test 2. All right. So on 1st November 2018, Gucci acquired an 80% equity interest in LV, retained earnings of LV at 7.5 million at the date of acquisition, agreed consideration 10 million in cash. So as you can see here, one is associate relationship, another one is your subsidiary relationship. So it matches the formula that I have created here. I just amalgamate Gucci and LV and I add console adjustments. I did not amalgamate Prada in, which means I did not combine the financial statements of Prada into the financial statements of Gucci and LV. The main reason is because we know that Prada is just an associate of Gucci. Okay, so that's why we have to maintain this part, investment in associate here. All right, so now we have the statements of financial position as of 31st December 2020 for Gucci, LV, and Prada. You have statements of profit or loss for the year ended 31st December 2020 for Gucci, LV, and Prada as well. Okay, so now the following additional information is available. Included in the trade receivables of Gucci is an amount owing by LV of 150,000. Current accounts of both companies did not balance due to a payment of 50,000 from LV being in transit at the year end. The second one, included in the inventories of LV are inventories purchased from Gucci during the year at a price of 39,000. Gucci earned a margin of 30% out of this sale. All of the goods still remain in the inventories of LV. Okay. On 1st Jan 2020, LV sold a machine costing 500,000 to Gucci at 550,000. Gucci had taken up depreciation of 10% amounting to 55,000 on the machine. Okay. It is the company policy of Gucci to revalue its building. So as at 31st December 2020, Gucci's building had a fair value of 12 million, carrying amount 15 million. Revaluation has not been recorded by Gucci as at 31st December 2020. Okay. The next one, Gucci was notified that an ex-employee had initiated court proceedings against the company for unfair dismissal. Legal advice has determined that there is 80% chance that Gucci would lose the case and would need to pay compensation estimated at 1 million on 1st December 2021. So Gucci recorded a provision of 700,000 for the compensation on 31st December 2020. Amount was included in expenses. Case was settled out of court on 13 January 2021. Sum of 500,000 was paid to the employee. Okay. The next one will be Gucci has charged management fee of 500,000 to LV, recorded it as a revenue. LV recorded the amount under expenses. All right. And there is no impairment of goodwill, and it is the group's policy to value NCI at fair value. At the acquisition date on 1st November 2018, NCI of LV was valued at 1.45 million. So you need to prepare consolidated statement of financial position and consolidated statement of profit or loss of Gucci Berhad Group for the year ended 31st December 2020. Notes to the financial statements are not required, but all workings should be clearly shown. No decimal points are required. Okay, so we have a few informations here, 7. in total. Okay, so not much lah, not many informations only. So easy peasy for everyone. Nope. Okay, give up. Okay. Give up, then can move to page 7. Okay, no problem. All right, so now the first thing, I have already read all the informations and I have already read the requirements. So the requirement wants me to prepare consolidated statement of financial position and statement of profit or loss. Okay, so I have already prepared. All right, I have already prepared here. All my skeletons are here and then my steps are also here. All right, so now, the first thing, what I need to do is still the same, since I know that I have an associate and a subsidiary. So I will need to be able to identify what are my step 1, what I need to do. So of course, since you have a subsidiary, you know that subsidiary is complying to full consolidation method, associate is complying to equity method. So full consolidation method, you have more things to do, while equity method, you only need to take in the share of profit and then you just need to calculate accordingly. All right, so full consolidation method, what you need to do first step, can anybody tells me, if I have a subsidiary, what is my first step before I move on? Anyone? Nobody? I have 37 students here. Nobody wants to talk to me. So kesian ah. Can I know what is the first step that I need to calculate? Turgashini mentioned goodwill, but before we calculate goodwill, what should we do? NCI, yes, thank you very much. Chipping consideration, no, yeah, chipping. Okay, but Gayatri is very clever. Yes, thank you very much. And Turga is also almost there. So congratulations as well. Okay, so correct. The first thing you need to calculate is NCI and acquisition. Sorry, yeah, 1 minute. Okay, sorry for the disturbance. Okay, yes, you are right that we have to calculate NCI at acquisition before we even start with all other calculations. So always remember, okay, when you prepare your consolidation, as I have already mentioned with all of you, I've mentioned to all of you that in your exam, definitely consolidation will be the first question. Okay, so it is very important for you to be able to prepare the skeletons for consolidated statement of financial position and consolidated statement of profit or loss correctly. All right, that was the first step and the most important step basically. All right. So after you have prepared all the skeletons, the first step that you need to do, always remember it will be your step one, which is your non-controlling interest at acquisition. And let's have a look. What is the group's policy for your non-controlling interest at acquisition? Okay, so the question has already provided to you. It is the group's policy to value NCI at fair value. At the acquisition date on 1st November 2018, NCI of LV was valued at 1.45 million. So question has been very generous to you. They have already provided the fair value to you. So you don't need to calculate your non-controlling interest at acquisition anymore. Then we can move on to step two, which is as per what mentioned by Tugra just now, goodwill calculation. So how do you start off with your calculation of goodwill? Now, the first thing you need to identify the consideration transferred. Okay, so according to the question, consideration transferred to acquire 80% equity interest in LV was 10 million. So of course, you can take in accordingly. Okay, and NCI at acquisition question has already provided to you 1450 less fair value of the net assets of LV. So what are the fair value of the net assets of LV? According to the question, they didn't mention that there is any changes in share capital or any revaluation surpluses of LV since the date of acquisition. So these are something that you don't need to handle. You don't need to care already. You know that you just need to follow according to the equity parts of the subsidiary. Okay, so your statements of financial position under the equity part, you only have ordinary shares, you only have retained earnings. So these are the two things that you have. So that's why you need to take in accordingly. So for LV, your ordinary shares is 1 million. And retained earnings at acquisition question has already provided to you. The retained earnings of LV stood at 7.5 million at the date of acquisition. So you just take in accordingly. Okay, so after you have taken in, your goodwill is amounting to 2950. Okay, so if you still remember, in last week, I think last week, I taught everyone to do in a form of debit and credit, right? Okay, and then I teach you how to allocate in your retained earnings accordingly. And I noticed that a lot of students, they might have birds flying up their head. Okay, so which means you are confused, you don't know why is it presented in this manner. Now basically that was the double entry. So in the event that you find it is too complicated, then now I will just teach you the very basic one. All right, the basic method is that definitely you won't be able to tally this part. All right, but eventually somehow or rather you will be able to tally after you have completed all the steps. Okay, so now we will make adjustment first. Let's adjust. We adjust goodwill first. Okay, I take in goodwill. So after I have taken in goodwill, there are only a few things that I want my students to adjust straight away, adjust immediately. So what are the things that I want all of you to adjust immediately? Number one, I want you to adjust investment in subsidiary to offset it completely. After you have taken in goodwill, you should offset investment in subsidiary. The main reason actually is because you have already taken in the consideration transferred, which means your investment in subsidiaries in goodwill calculation. So you still remember the part, the credit part, okay? So you have to offset accordingly. Okay, so after you have offset this part, I also want my students to offset the equity parts of the subsidiary to only reflect the parent's share capital. This is the next thing that I want all of you to take note. Okay, so of course, cannot tally lah. This part cannot tally because you have these few adjustments that you have not made, but then we don't care. All right, we don't care about this first. All right, so we will just move on. Okay, so cannot tally, yeah? We just move on, tak apa. All right, so now we will move on to the first additional information. So the first additional information, trade receivables of Gucci is an amount owing by LV of 150,000. So trade receivables of Gucci is an amount owing by LV. So which means Gucci is seeing 150,000. Maybe they have a sales of 150,000 to LV in the past. The current accounts of both companies did not balance due to a payment of 50,000 from LV. Okay, so which means to LV, basically, this is a purchases and it's reflecting a trade payable sign. Okay, so to Gucci, basically, it's a trade receivables of 150,000. To LV, it's a trade payables of 150,000. So as you can see, the owing basically at the end of the day, it is amounting to zero. So considered as balance. All right. But according to the question mentioned to you cannot balance by 50,000. Because of what? Because LV say, hello, I have already paid you 50,000. Okay, I already pay you 50,000. So currently reflected in my trade payables is only 100,000. But Gucci is claiming 150,000. So what you should do? You have to take in accordingly as well. Because this is a subsidiary, so most of the time we will assume, we will really believe that the amount has already been paid. And of course, when you come out to work, okay, this kind of scenarios always happen in a parent versus subsidiary relationship. It is very common that it will happen. Okay, so don't be surprised. And most of the time, there will be this out of balance because of the payment made at the end of the day. All right, at the end of the year, not at the end of the day, it's at the end of the year. And it is very normal. So what we do is we will just ask bank slip, proof of payment from LV, okay, to support that, okay, you really have already paid 50,000. Then never mind, from Gucci's part, I will assume that I have already received this 50,000. Okay, in order for your intra-group balances to tally. But of course, you need to have supporting documents as a proof. With this proof, I can actually just take in this transaction already. And then my intra-group balances will tally. So now the first adjustments that we have to make, because we know that LV has already taken in this transaction, but this transaction has yet to be taken up by Gucci. So what you do? You have to take in accordingly. So I assume I receive 50,000. So my trade receivables will be reduced by 50,000. Okay, so now we have already done up the first transaction. Now this is an intra-group balances here. There's an intra-group balances, which means trade receivables, there's 100,000, trade payables is 100,000. And this we will also have to offset from our trade payables minus 100,000 and also offset from our trade receivables minus 100,000. Okay, so as you can see here, up until now, the out of balance is still on 6050. So just for your information, you want to know how to derive to this, it's because you did not adjust on NCI at acquisition and the retained earnings at acquisition. So as you can see here, my sum is 6050. Okay, it's because of these two adjustments. So as you can see, this whole note 3, right? This whole step 3 note 1, there is no impact on your statement of financial position at all. The main reason is because number one, you take in to you have adjusted your bank, you have also adjusted your trade receivables. So which means you adjust current assets on both sides. All right, and then you have adjusted trade payables, you have adjusted your trade receivables as well. So the adjustments basically it is tally, which simply means that you are only adjusting in your statement of financial position. Okay, it has no impact on your statement of profit or loss at all. All right. For this part, everyone can understand? Can you raise your hand? If you can understand, then I will move on. Okay, good job. Thank you. Then I will move on. So the next one, included in the inventories of LV are inventories purchased from Gucci during the year at a price of 39,000. Gucci earned a margin of 30% out of this sale. All of the goods still remain in inventories. Okay, so here, I believe everyone must be an expert in calculating this part. Okay, so included in the inventories of LV are inventories purchased from Gucci. So based on my explanation here, parents sell inventories to subsidiaries. So the unrealized profit will be adjusted from parents' retained earnings because parent is the one earning the profit. Okay? Because Gucci mentioned Gucci earned a margin of 30%. And since this is a margin, so it will be divided by 100. If it's a markup, it will be divided by 100 plus the markup. Okay, so it will be more than 100. If it's margin, divided by 100 only. So 39,000, they have already mentioned to you, 39,000, it still remains, all 39,000 ringgit worth of inventory still remains in the inventories of LV. Okay, so which means this 11,700 unrealized profit will have to be adjusted out. And they have also mentioned these are inventories purchased from Gucci during the year. So simply means that this is intra-group revenue and purchases as well. So intra-group revenue and purchases, what you should do, you have to take in 39,000 minus 39 and add 39. Okay, so you have to minus 39 and also to add 39. All right, the main reason is because this is a sale that occurs during the year. Okay, so after you have adjusted, as you can see, it will not have any impact in your net profit after tax. So you can calculate here. Wait, let me see. Something wrong somewhere with the calculation. 1316. Oh, okay. Yes, correct. It will not have any impact on your calculation. Gucci plus LV 2071 plus 1143, you will get 3214. Okay, so there is no impact on intra-group sales and purchases transactions, sales and purchases knockoff. Okay, so 39 and 39, after you have offset, then you can already move on with your unrealized profit offsetting. So this unrealized profit 11,700, you have to offset from your cost of sales. Okay, so which means you have to minus 11.7. Okay, and from your inventories position, you also have to minus 11.7. Why is that so? The main reason is because you are actually reducing the closing inventories of this 11.7, 11,700. Okay, you are actually reducing the closing inventories. So that's why you also minus off from your cost of sales, which means you are increasing your cost of sales because your closing inventories are reduced. Okay, so that's why you increase cost of sales, reduce closing inventories. So your closing inventories in current asset will also be reduced by the unrealized profit portion. Okay, so now you have already adjusted. You have already adjusted on this part. Now you can actually straight away take in from your group retained earnings calculation. Okay, so your group retained earnings here, we have, this is actually step 4. Step 4, okay, so step 4 here, we know that basically unrealized profit will be adjusted from the parents' retained earnings. So we will adjust from the parents' retained earnings straight. So just minus 11.7 first. Okay. Okay, so your unrealized profit, step number 4, you will minus your 11,700 from your group retained earnings first. Okay, so this is the next step. Then on 1st January 2020, LV sold a machine costing 500,000 to Gucci at 550,000. Gucci had taken up depreciation of 10%, amounting to 55,000 on the machine. Okay, so the next step, basically, LV sold a machine to Gucci. Subsidiary is selling to the parent. Okay, and basically they have also mentioned that they sell at a price of 550,000 when the cost is 500,000 only. So that's why I have this profit on disposal of 50,000, and the excess on depreciation, it's basically Gucci had taken up depreciation of 10%, amounting to 55,000 on the machine. But your excess on depreciation, it's basically reflecting the 10% on your profit on disposal. Okay, 10% on profit on disposal. So if you remember my explanation last week, last 2 weeks, I have already mentioned to all of you that basically for profit on disposal part, you need to identify who is the one selling. Now, subsidiary is the one selling. So since subsidiary is the one selling, you have to adjust from the subsidiaries retained earnings. Okay, you have to adjust from the subsidiaries retained earnings and currently reflected in the parent's book, because according to the question, Gucci Gucci is the one acquiring the machine at the price of 550,000. So reflected in property, plant and equipment of Gucci, the cost of the machine is 550,000. So now my aim is to return it back to 500,000 value. So that's why minus 50, so that I can return the value back to 500,000, because 550 minus 500, so there is an additional profit on disposal of 50,000. So this 50,000, after I have minus it off from my console adjustment, basically Gucci's property, plant and equipment on the machine part, it will return back to the value of 500,000. And of course, you have to adjust from your other income as well, minus 50,000. Okay, because your profit on disposal recognized by LV is an additional of 50,000 here. So after I have taken it out, basically other income in LV is only amounting to 91,000. Okay, so this 50,000 you have already adjusted. Now we can also take in the group retained earnings. So in this group retained earnings, we have profit on disposal, which is your step 5. And since LV is the one earning the profit on disposal, so we have to adjust from LV's retained earnings. Okay. And then we still have one more step that we have to do, which is on the excess depreciation. Now, who is the one depreciating? Currently, parent is the one depreciating because Gucci already owned the machine. So Gucci is currently depreciating. So since Gucci is depreciating, we can say that Gucci has over depreciated because the value of the machine has returned to 500,000. But the depreciation is basically reflecting an additional of 5,000 because the depreciation is 55,000. 10% of 500,000 is only 50,000. So there is an additional of depreciation charge of 5,000. So that's why I will have to add another 5,000 to return the depreciation charge back to 50,000 only. And this excess depreciation that I have charged under my, since it's a machine, so I will adjust in cost of sales. Under my cost of sales, I will have to add another 5,000. So once you have added 5,000 in your cost of sales, it actually reduces your cost of sales because my cost of sales, I am using a minus sign symbol, all right, a minus symbol. So if let's say I add, it simply means that my cost of sales has already been reduced. Okay, so now your 5,000 you have already adjusted from your console SFP and console SPL. So I will also have to adjust from my group retained earnings. So here I am adjusting from the add part of 5,000 under Gucci because Gucci is the one depreciating the asset. Okay, so understand this part. Can you raise your hand if you can follow me so far? No raise hand. No raise hand means cannot follow. Is it? Zhihong, you raise hand means cannot follow or you can follow, ah? Can, ah? Okay, what about the rest of you? Or are you still with me? Now I'm not joking, because this part is very important, okay? Do not blame me if you cannot make it in your exam, all right? I have already specified to all of you that this consolidation is one of the compulsory question that you have to answer, and it's amounting to 40 marks, all right? So if you cannot understand, you have to let me know, okay? The rest can understand. Can you raise your hand if you can understand? No raise hand means cannot understand, So only a few of you can understand. What about the rest? The rest, do you need me to repeat? Can you raise hand if you need me to repeat? Okay, so Arun needs me to repeat. Shipping wants me to repeat. What about the rest? Okay, so only a few wants me to repeat. Then what about the rest? The rest of you, are you still with me? What about the rest? Because the lesser raise hand that I receive, the worrier I will get, because I don't know whether you can understand or not. And then during your lecture, a lot of students, they will tell me I cannot focus on 7 topics lah, all these kind of things. But then have you ever thought of, when I ask you questions, you all never answer me, then it is very difficult for me to even gauge whether you can understand or not. During lecture, when I do poll questions with students, students are not giving me a good feedback on the poll. It's also very difficult for me to be able to measure. Okay, so I will repeat, never mind. Okay, I will repeat one more time. All right, let me just erase off. I will repeat from the unrealized profit portion. Let me just erase this off first. Okay, so at this point, I believe everyone must be able to understand for your question number 2, your step, your question 2, your information number 2, note number 2, okay, because LV purchased from Gucci at the price of 39,000. So this is considered as intra-group revenue and purchases because it happens during the year. So that's why you have to take out this intra-group revenue and purchases. Why? Because consolidation always reflect third-party transactions only. All right, remember that we only reflect third-party transactions only. So all these are considered as a third-party transactions. There are no internal transactions anymore. Okay, this is what we want for consolidation. Okay, so now, Gucci earned a margin of 30%. Okay, so this 30% is a margin. So since it's a margin, so it will have to be divided by 100. If it's a markup, it will be divided by 100 plus markup. So it's more than 100. So since margin divided by 100 only. So the question has already mentioned all of them remains in the inventories. Semua. So everything remain in the inventories. You will take in 39,000 times 30 over 100. So the unrealized profit portion is 11,700. Okay, so this 11,700, you will have to offset from your cost of sales. So minus 11,700. Okay, offset from your cost of sales. And as you can see here, when I use minus sign, it simply means that I am increasing the value of cost of sales because I am all using minus sign here. So if it's another minus sign, simply means that this 11,700 of closing inventories reduction has already increased the value of cost of sales. And under your inventories part, you also have to adjust 11,700 because I already mentioned to everyone that I am reducing the closing inventories in cost of sales. Okay, so if you cannot remember what is cost of sales, how do you derive? Now, ladies and gentlemen, cost of sales, basically we have opening inventories less, add purchases, okay, and less closing inventories. Okay, so now I am actually reducing this value. So that's why I am increasing my cost of sales. Okay, so I'm reducing this part. All right, so that is your cost of sales. Okay, so after I have taken in this part, I know I cannot tally. And the cannot tally part is because of the adjustments that you did not make. Okay, your NCI at acquisition, your retained earnings at acquisition adjustments you have yet to make. So definitely cannot tally. Okay, so don't bother first. Don't feel panic. You will be able to tally at the end of the day. Okay, so I don't care. Now I will just have to take in 11,700 in the retained earnings. But I need to adjust from whose retained earnings now. Then it depends on who is actually earning the profit. So based on this note, it seems like parent is earning the profit because Gucci earn a margin. So Gucci earns the profit. So the unrealized profit portion here, you have to minus off from Gucci. Okay, because Gucci is the one earning the profit. All right, so I have already adjusted my group retained earnings part. Okay, so for this part, everyone can understand. Can raise your hand if you can understand. Okay, thank you. So can understand, then we will move on now. Okay, so the next one, we are talking about machinery. Now, if you still remember my lecture and my tutorial 2 weeks back, okay, I have already mentioned about a once upon a time story here. So what is this story all about? Now, the first thing is LV sold a machine to Gucci. So subsidiary selling to parent. And the cost of the machine, okay, cost of the machine is actually amounting to 500,000. Okay, so selling price is amounting to 550,000. Okay, so the cost of machine 500,000, selling price 550,000. So definitely there is a profit on disposal of 50,000. Currently reflecting in the book of Gucci is 550,000 because LV sold the machine to Gucci at 550,000. But according to the elimination rule, we want to return the cost of the machine to 500,000 to reflect at 500,000 rather than 550,000. That was the rule of elimination. Okay, so in order for me to return the value back to 500,000, I will have to minus off this 50,000 because currently reflected here, there is a 550,000 worth of machine in 16,536 million of property, plant and equipment in Gucci. Okay, there is this 550,000. So after I have minus of 50,000, it will return back the cost to 500,000. Okay, for this part, everyone can follow. Can raise your hand if you can follow. Okay, thank you. Can follow. Okay, then now we know that we have already returned the value back to 500,000. Of course, you also have to take out the 50,000 whereby this LV has already earned from the sale of asset. Okay, because LV mentioned I sold a machine costing 500,000 at 550,000. So there is a profit on disposal element here. Since I have already returned the value back to 500,000, I am actually assuming that I have not sell any assets at all during the year. So that's why according to the elimination rule, you also have to minus off this 50,000 earned from your parent or from the subsidiary, whichever is applicable. Okay, so now I have already taken out from other income. And then I will have to adjust my group retained earnings. So my group retained earnings, profit on disposal, I need to know whether I have to minus off from Gucci or from LV. So let's look back at the question. Question mentioned LV is the one selling. So simply means that LV is the one earning the profit on disposal. Okay, so since LV is the one earning the profit on disposal, so we have to minus off 50,000 from LV's retained earnings. Okay, and then now we can move on to the next part, excess depreciation. The excess depreciation, basically, how do I derive to this 5,000? Okay, so your cost of the machine is 500,000, selling price 550,000. So if following 10% ruling, your depreciation on this part is RM 50,000. Okay, as for selling price of 550,000, your depreciation will be amounting to RM 55,000. Okay, so here, as you can see here, if I have written my machine value back to 500,000, the depreciation should be 50,000 only. But currently, according to the question, Gucci had already taken up the depreciation amounting to 55,000. But the value of the machine has already returned to 500,000. So the depreciation will have to be based on 500,000 rather than 550,000. So that's why, as you can see here, there is an excess depreciation of 5,000. And this excess on depreciation, you will have to add back. Okay, simply means that Gucci currently I have 550,000 worth of a machine. Okay, and Gucci also mentioned he has already taken, just use this, he has already taken up depreciation of 55,000. So I have this 550 minus 55. So it's amounting to 495. Okay, so according to Gucci, the carrying amount of the machine is 495. But after I have adjusted 45,000 accordingly, okay, so which means I have to plus 50 and I have to minus 50 and plus another 5. Okay, so after I have made this adjustment accordingly, minus 55 minus 50 plus 5, so 550 minus 55 minus 50 and plus 5. Yes, so you will be able to get 450,000. Okay, so before adjustment, it's amounting to 495,000. After adjustment, 495 minus 45, you will get 450,000. So that was the carrying amount, the original carrying amount of the asset. Your machine original cost 500,000, depreciation 10% of 500,000, you will get 450,000. So that was the rule of elimination. That was the objective that we want to achieve. Currently reflected in Gucci's carrying amount is 495,000. So after I have adjusted 45,000, I should reflect 450,000 of carrying amount for the machine. Okay, so after you have taken in this 5,000 excess depreciation, okay, because it's an excess depreciation, so you have to add back to your cost of sales, okay, in order to decrease this depreciation. Okay, you have to decrease the depreciation charge. So which means more income or additional profit for the company already. So that's why you add back 5,000 ringgit, okay, to reverse the depreciation. All right, so after you have taken in this 5,000, then you have to adjust accordingly, whether you need to adjust in Gucci, LV, or Prada. Now, according to the question, Gucci is the one depreciating. So any excess depreciation will have to be adjusted from Gucci's retained earnings. Okay, everyone can understand this part? Can you raise your hand if you can understand? Okay, thank you. Okay, thank you. All right, then let's move on. The next one, it is the company's policy of Gucci to revalue its building. As at 31st December, Gucci building had a fair value of 12 million, carrying amount 15 million. Revaluation has yet to be recorded. Okay, so the fair value is 12 million and the carrying amount is 15 million. So as you can see here, there is an impairment loss altogether because the carrying amount was 15 million, but the fair value was 12 million. So your impairment losses of 3 million will be recognized. So this 3 million of impairment losses, you will have to account for in your property, plant and equipment to reduce the value of the building. Okay. And next one, I will minus off from my expenses part, okay, to reflect the impairment losses as well of 3 million. Okay, and this 3 million, since it's only related to Gucci, so always remember, since we have an impact on the statement of profit or loss, we will also have to account for in your group retained earnings as well. So minus impairment losses of 3 million from Gucci's perspective. Okay, so this part you must be able to adjust because this is just related to the parent side. Okay, the next one, on 1st June 2020, Gucci was notified that an ex-employee had initiated court proceedings. 80% chance that Gucci would lose the case and will need to pay a compensation estimated at 1 million. Gucci recorded a provision of 700,000 already. So which means they have actually recorded a provision of 700,000 and it was included in expenses part, included in this part here. Okay, they have already taken in here. But according to the question now, this case was settled out of court on 13 January 2021 and a sum of 500,000 was paid to the employee. Okay, so 13 January 2021, they have decided to settle this out of court and agree to pay 500,000. But you have already recorded a provision of 700,000. So this is considered as over recognition of provision. Okay, so you have to reverse out your provision of 200,000. So this 200,000, since it was recorded in your expenses, so you have to add back 200,000. Okay, add back 200,000, and of course you have a debit side, you must have a credit side as well. So it should be taken in trade and other payables. So you have to also take out 200,000. Okay, so why? Now let me just share with you again. This reversal of provision. Now before reversal, okay, before reversal, how do you account for your provision? You will debit expenses, okay, and then you will credit provision, right? Provision for liability, okay, and this provision for liability usually they will take into these trade payables and accrued expenses, unless it is material that you feel that you want to reflect it in you want to reflect it separately, then of course you can also reflect it separately, because minimum disclosure requirement in IAS 1, if I did not forget, okay, IAS 37 provision, contingent assets and contingent liabilities should also be disclosed separately. But in the event that you find that it is immaterial, that you do not wish to disclose separately, you can of course disclose in trade payables and accrued expenses, and then you still notify the users of the financial statements in the form of notes to the financial statements. Whereby trade payables and accrued expenses, usually we also have notes to the financial statements to support, and then we also have another note called legal proceedings, whereby we will update the users of the financial statements on all the legal proceedings that occurs in the company. Okay, so information will still be furnished anyway. All right, so this 200,000, that's why I chose to minus off from my trade and other payables, since there is no other information provided here. Okay, they didn't take in this provision for liabilities, or they didn't account for provision for liabilities separately. So that's why I will just minus off from trade and other payables here. So that the provision for liabilities has already been reduced by 200,000. Okay, that was for number 5. Everyone can follow this part? Sorry, I need to get everyone to raise hand again if you can follow. Can raise hand if you can follow this part. Okay, thank you very much, everyone. Then I will move on. Okay, for the year ended 31st December, Gucci has charged management fee of 500,000 to LV. LV recorded the amount under expenses. So this part, basically, you only need to account for accordingly based on the intra-group revenue and purchases. So you just minus 500,000 from revenue and plus 500,000 from the expenses. Okay, because this is just like intra-group revenue and purchases, a very normal one. So you just need to account for accordingly. And the last one, there is no impairment of goodwill. Okay, so which means we have all completed, should be completed lah. Huh? Let's see anything. Reversal of provision we have not taken in yet. So let me just take in the reversal of provision. So basically we have already taken in everything. Okay, so we have already taken in everything. So now we can actually account for the sharing, the profit sharing accordingly. So for profit sharing here, as you can see, LV, Gucci and Prada for your group retained earnings, okay, you always start off with as per statement of financial position. And this is just a very simple linking only. So I just attach or I link to the retained earnings, the respective company's retained earnings. Okay, so it's just a very simple linking only. And then less pre-acquisition RE, basically for this LV, you will be able to obtain the data from your goodwill calculation. You have this retained earnings at acquisition. Okay, as for Prada, the amount was 6 million. So how do I derive to 6 million? It is actually according to the question. Question already mentioned, equivalent to 250,000 shares 2 years ago at a price of 800,000 when Prada's retained earnings was 6 million. Okay, so we have already taken in accordingly. So now you can already calculate your sharing, profit sharing. So my profit sharing for LV, it will be 80%. Okay, as for Prada, it will be 10% only. Okay, so now my group retained earnings is 34161.3. Okay, and my NCI at year end, basically I have already calculated. This is 20% of 2450. I can also do the linking here. Okay, so my NCI at year end will be equivalent to 1940. As for my share of profit in associate, which is the last step, my investment in associate according to the question is 800,000. This is at cost. Okay, and then at sharing of profit, so my profit sharing is 200,000. So I have already taken up here. Okay, so now I can actually adjust accordingly for all the parts that I cannot tally. Okay, so now let's adjust. My retained earnings currently show 44808. But basically, we only want to reflect 34161.3. So what I do, usually I just minus off from the subsidiary and parent. Why I minus these two off? The main reason is because my calculation here, I actually involve B and C only, which means Gucci and Prada only. Okay, Gucci and LV only, sorry. Gucci and LV only, parent and subsidiary only. So that's why I just do a very simple linking, okay, to find the adjustments so that at the end of the day, I will get 34161.3, okay, which is equivalent to my group retained earnings. And then my NCI at year end is 1940. So let's take in 1940. Okay, so I have already taken in my non-controlling interest, 1940, and you will still see out of balance of 200,000. Why? The main reason is because your investment in associate, it's amounting to 1 million. Okay, because you have your profit sharing as well. So a very simple one, I just minus off from 800. So there is this 200,000 variance. So my console here, it will be amounting to 1 million. So as you can see here, at the end of the day, you will still be able to tally. Don't worry about that. Okay, so that will be on your console statement of financial position. Everyone can follow up until this part. Can you raise your hand if you can follow? Okay, thank you. Everyone raise hand, can follow. Okay, thank you very much. Okay, so I will move on then. So now we will focus on your statement of profit or loss portion. So my statement of profit or loss portion, basically we have already adjusted what we should adjust. Okay, and the next one will be on your profit sharing on the associate. So as you can see here, you will notice that in your group retained earnings, since there are no adjustment for product, okay, except for your pre-acquisition RE, there are no other adjustments that occurs during the year. So don't bother about adjustment already. You can just take in accordingly. How to take in? You just take in 10% since the shareholding in Prada is 10%, so times 729. Okay, so basically the profit sharing is 72,900 for Prada's portion. Okay, so as you can see here, at the end of the day, the net profit after tax will be amounting to 430 ringgit and 20 cents. So the profit attributable to parent is 211.6, NCI is 218.6. So total is amounting to 430 ringgit, 430,200, 430,200. But how do you derive to this 218.6? Basically, as you can see here, I have my formula, a very simple one. Okay, I just take in net profit after tax of LV and I add on to my group retained earnings adjustment. So basically for LV, there is only one adjustment, which is the profit on disposal, whereby LV has earned from selling the machine to Gucci of 50,000. Okay, so that's why you just need to take in 1143 minus 50 times, this is a 20% because Gucci own 80%. Okay, Gucci own 80% of LV. Okay, so after you have take 1143 minus 50 times 20, you will get to 18.6. So considered as the balancing is 211.6, but I don't really like to share with my students on how to on explaining to them that this 211.6 is a balancing, because it is very dangerous for students if you don't know how to calculate profit attributable to parent correctly. So that's why I would like to share this with all of you as well. So as you can see here, for LV's part, okay, you already know that LV you have one adjustment. So minus 50 times 80%, you will be able to derive to 874.4. So 874.4 plus 218.6, you will get 1093, which is after the adjustment. Okay, so for Prada, since you know that there is no adjustments, okay, there is no adjustment, you just need to take in 729 times 10%. Okay, so this is 72.9. And the last one, the last part is on Gucci. Gucci is actually making losses, as you can see here. So why Gucci is making losses? Because they have a lot of adjustments to be made. So my profit before adjustment is 2071. Okay, so I minus off with all the adjustments related to my group retained earnings. So I have 11.7, okay, minus 11.7, and I have to add 5,000 for excess depreciation. And the main issue why I am making a loss is because of the impairment losses that I have taken in, and plus another 200,000 on reversal of the provision. So you can just take in 2071 minus 11.7 plus 5 minus 3,000 plus 200, you will get 735.7. Okay, so as you can see here, your statement of profit or loss, any adjustments made here, it will have an impact on your group retained earnings, except for those intra-group revenue and purchases, whereby this intra-group revenue and purchases, basically they don't earn any impact in your net profit after tax. Example like this 39,000, you plus and minus is actually the same thing. Okay, and this 500,000, you plus and minus is actually the same thing. So these are intra-group revenue and purchases that doesn't earn any impact on your net profit after tax. Okay, so that's how you derive to this 211.6. You have Gucci's portion, LV's portion, and Prada's portion. That at the end of the day, you will still be able to tally to this 211.6. Okay, so that's it for your associate calculation. Everyone can understand? Can you raise your hand if you can understand? So only 2% can understand, 3%. Okay, Okay, thank you. So I've seen more raised hand. So you are still with me. You have not, your spirit have not gone away. Okay, hope that you have not gone away. All right, so basically itu sahaja. If you have any questions that you want to ask, you can ask me now. Okay, or if you feel shy, you don't want to ask, also never mind. You can try to attempt these revision hub questions. Let me just show you again, just in case that you all are not aware about this BBFA 2024 revision hub. Okay, I have this May 2021 BBFA 2024 revision hub, and I will always post all my questions here. So I have posted this chapter 5 last part self-assessment, and I also have all the subjective questions and objective questions together with answers, all right, for your own revision purposes. Okay, so you may try to attempt. You have any questions, you can ask me anytime. All right, if there is no other questions, thank you very much, everyone. Have a nice day and take good care. Bye bye.